In the past 4 years, I deployed over $40 million in funding to small and medium-sized businesses and also trained hundreds of brokers on exactly how to get their clients approved for 6 figures in funding. And in this video, I'm going to walk you through every single step I take to get my clients approved for $100,000 or more in business funding consistently. All right, let's break this down step by step so you can literally plug this into your business and start getting more clients approved faster without trashing their credit. Most brokers think qualification means what's your credit score, how much do you want, and that's it. 2 questions and they're sending apps to every bank they can find. But here's the truth. When you qualify lazy, you waste hours on files that never had a shot, you blow up your client's credit with unnecessary inquiries, and you send trash files to lenders and ruin your reputation. To give a quick example, I had a broker bring me a client who already been declined every single where. Why? Because 3 different brokers ran that client through apps without checking payment history, looking at utilization, and analyzing banking activity. The client got multiple denials, more inquiries, and less trust in the whole funding game. If someone had qualified them correctly on the front end, they would have put them into credit repair, given them a 3 to 6 month game plan, been in a position to actually pull a $50,000 approval later on. Instead, the client came to us frustrated, shotgun with inquiries, and we had to rebuild the whole situation from scratch. When you qualify correctly, your close rate increases because you only work with real opportunities. Your time per funded deal drops, and your clients respect you more because you're honest, not desperate. Lenders start to like your files and take you serious. You're not looking to fund anybody who breathes and wants funding. You're looking for profiles you can confidently turn into a 20 to 100K in funding. This is how I properly qualify clients. For traditional credit-based funding, ideally you want a 720 plus FICO credit with a 680 and a strong credit profile, or 700 plus work if things are clean. No recent late payments in the last 6 to 12 months, utilization ideally under 35%, and at least 2 to 3 primary trade lines with decent limits and age. No bankruptcies, collections, or recent charge-offs. For revenue-based lending, $8,000 or more per month in consistent business revenue, a minimum 6 months time in business, and a real business bank account. No Cash App, Chines, or personal accounts. Little to no negative days or overdraft history. For revenue, credit can be lower, but we still want some responsibility being shown of them making some type of payments. My rule is simple. If I don't see a clear path to real funding, I don't sell them dreams. I give them a plan, move them into credit repair, education, or a nurturing campaign to fund later. So now I'm gonna go over my formula, CRD. Credit, relationships, and deposits. What most brokers get wrong, they hit apply like they're playing a video game. No order, no logic, no awareness of how one approval impacts the next bank. They end up with wasting inquiries, lower limits, and denials that could have been avoided. We had a client where their score was strong, profile was solid. The big difference between them getting 40 versus 100K was strictly the sequence. We started off with pre-approval lenders first. After, we went to inquiry-sensitive lenders, then layered on top major banks and credit unions that the client had relationships with, and then closed with more flexible lenders. Same client, different plan, way more funding. When you sequence correctly, you protect approval odds at each step. You maximize the total amount funded, you protect the client's profile for future rounds, and here's how you implement that strategy. You run everything through CRD. Credit, what does the actual profile look like? Is it thin or established? Relationships, where do they bank? Any existing deposit relationships? Deposits, how much money is actually moving through their bank? Then I lead with banks, credit unions that reward existing relationships and solid profiles. Hit more conservative major banks once we have a foundation of approvals. Add in flexible, non-traditional lenders that don't mind a few recent inquiries. I also coordinate the timeline, which leads into the compressed timing strategy we'll talk about later. What most brokers don't know is most banks and card issuers pull a primary bureau, whether it's Experian, Equifax, or TransUnion, and some pull a mix depending on the region and product. Most brokers don't know which bank pulls which bureau, how many inquiries is too many on each, and how to protect one bureau for future funding. So they accidentally burn all 3 at once. Here's a quick example of a client that we actually had, right? They had 2 bureaus that were already heavy on inquiries. One bureau was still relatively clean. Instead of blindly applying everywhere, we targeted banks that primarily pulled that clean bureau, protected the heavier bureaus for later rounds, and kept the total amount of inquiries on each side under control. If we just went to random lenders, the client would have racked up a ton of denials, lost future funding opportunities, and then we would have to go through repair to move inquiries before going forward with additional rounds. When you understand smart targeting, it allows you to stretch a client's profile longer, increase total amount of funding per round, and avoid overloading one bureau and triggering internal risk flags. In order to implement this, you want to build a cheat sheet for yourself. Which banks pull Experian, which pull TransUnion, and which pulls Equifax. Then when planning a stack, you decide, I'm going to lean on Experian and TransUnion this round and protect Equifax, or vice versa based on the inquiry spread. Now you're playing chess, not checkers. What most brokers miss is that banks have internal rules and limits. Some examples that are well known in the credit game are the Chase 524 rule, where too many new accounts in the last 24 months can lead to an instant denial with Chase. Certain banks limiting the number of cards within a time window. Internal exposure limits, where if they already gave you enough, they tighten up. Most brokers never study this. They just keep hitting walls and blaming the economy or the lender. To give you guys a quick case study, we had a client where on paper they looked perfect for a certain bank, but because we understood the threshold of how many new recent accounts that bank favored and the utilization they typically want to see on existing business credit cards, we knew applying there right now would likely trigger a denial. So we skipped that bank in this round, ran through others first, circled back later when the client's profile and the timing fit better. That's how we avoid a denial that would have added another hard inquiry, lowered trust with the client. Knowing the rules means you can increase your approval odds, avoid unnecessary denials, preserve your client's profile long term. I treat it like a living lender playbook. Track what banks are approving and what they're declining. Note patterns like too many new accounts or too much exposure. Update my internal rules as the market shifts. Before any application, I'm asking, is this bank a good fit for this exact profile today? If the answer is no, we pivot. Some brokers only know how to do credit card stacking, which means great credit but no revenue, they can help. Great revenue but average credit, clients need money fast and doesn't care about long-term rates, they have no tools. They're a one-trick pony. We work with a business owner doing strong monthly revenue, but their personal credit wasn't ideal. They needed money quickly to take advantage of an opportunity. Traditional wasn't going to be the best first move, so we positioned a revenue-based solution. Got them funded quickly, helped them use that capital to stabilize and scale. Then we later repositioned them for better longer terms and funding when their profile improved. That client became a repeat funding client, came back for renewals, sent referrals. When you add alternative lending, your market expands. You're not turning away people who can be served. You create multiple revenue streams from the same lead flow. In my mind, every client falls into one of these three buckets. Traditional, strong credit profile, maybe limited revenue. Alternative, strong revenue, weaker credit profile. Or hybrids. They have both, strong credit and revenue. Instead of forcing one product on everyone, I position myself as the funding strategist. Here's the path that gets you capital the fastest, safest, and most strategically. That's how you become valuable, not replaceable. Most brokers spread applications across random weeks. One app this week, another app 2 weeks from now, another app next month. By then, new accounts have hit the report, inquiries have updated, the profile looks heavier and riskier. So banks later in the sequence pull back hard. We've seen this play out multiple times. Client A runs scattered apps, which leads to smaller total approvals. Client B, with a similar profile, runs strategically compressed apps, which leads to much higher total amount funded. Because we hit banks before all the new accounts have fully updated. The profile still looks lighter at the time of each decision. Compressed timing helps you to maximize total funding in a single round, take full advantage of how reporting cycles actually work, prevent banks from seeing a freshly overbuilt profile all at once. Once qualification, docs, and strategies are locked in, we plan the full sequence first. Run applications in a tight window, typically within the same 24 to 48 hours, monitor approvals, and adjust where needed. The key is strategy, not panic and random clicking. A lot of people send lenders half-completed applications, inconsistent bank statements, blurry screenshots instead of proper PDFs, and random files all over the place. This screams amateur to an underwriter. We saw two versions of the same client in the real world. One broker submitted messy docs, missing pages, mismatched information, instantly denied. We took the same client, cleaned everything up, presented it clearly, and got an approval. The client didn't change, the presentation did. clean and professional docs, build trust with underwriters, and speed up reviews and decisions, make lenders more open to working with you long term. My document process, we use checklists to make sure all required documents are present, bank statements are complete, in order and readable, business info is consistent across all forms, explanations for anything weird in the statements, files are clearly labeled and easy to scan. Before it ever hits a lender, it passes our own internal review. Top brokers don't just send deals, they build real lender relationships. They know their reps by name. They communicate consistently. They respect lender guidelines. Struggling brokers, on the other hand, only call when they want something, never ask what lenders are currently looking for, and blame lenders instead of adapting. We've had files that were borderline on paper, technically could have gone either way. Because of our relationship, the rep actually took a deeper look, asked a few clarifying questions, pushed for approval where a cold file might have just got declined. That doesn't happen if you don't build real relationships. Strong lender relationships give you second looks on borderline clients, clear feedback on why something was denied, early info on new products or changes in the industry, more willingness to work with you on unique situations. And my honest approach to building relationships is send clean and honest files, don't hide information they will obviously see in the docs, communicate early and respectfully, check in periodically to see what they're seeing in the market, be the broker that makes their job easier, not harder. When you do that consistently, lenders start rooting for you instead of just reviewing you. The fastest way to ruin your brand is to overpromise. You see it all the time. Guaranteed 100K, everyone gets 6 figures. No impact, no downside. Then when reality hits and the numbers don't match the story, the client loses trust, leaves bad reviews, and tells everyone you're a scammer. I've had clients come in expecting crazy numbers because of what they saw online. Instead of feeding into it, I'll say, based on your profile, here's what you can comfortably expect, here's what's possible, and here's what's realistic, and what we can do and how we can get it done. We set a real range and landed them in a strong position because their expectations were set properly. They felt taken care of. They were happy with the result. They refer other people. To manage expectations, you want to build long-term trust. Keep clients calm during the process, leads to repeat deals and referrals. This also protects your reputation in the space. And from day one, I keep it real. I tell them what I like about their file. I tell them what could be a problem, and I give them the best case, realistic case, and what happens if things go left. I frame funding as a tool, not magic. I'd rather someone respect me for telling the truth than love me for 2 weeks and hate me forever after. There's a lot here, but if you take any one of these things I mentioned, then I'm sure you'll start seeing your approval rates increase and be able to get your clients funding faster. Of course, the approval strategies are just one piece of building a successful funding business. You still need the lender, relationships, the client acquisition systems, the proper CRM setup, and the fulfillment processes to turn approvals into consistent 5 and 6 figure monthly income. So if you want to see the complete step-by-step system I use to help brokers build 6 and 7 figure funding businesses from scratch, click the video on the screen now, like and subscribe for more funding videos. Peace.